Okay, over the last 24 hours, we've seen a very big sell-off in global financial markets. Europe, North America, Far East, all of them have been really, really under pressure for the last 24 hours. And there are two really big reasons for it. One is the state of the US economy. People are really worried about the US perhaps going back into recession. And the other is the dire state of the single currency and the question of whether it can actually survive this intact. It's really significant because the global economy has barely emerged from the last recession. We had a really big downturn in the global economy in 2008, 2009, which followed the credit crunch of 2007. There's been a sort of sporadic, tentative, weak recovery in most of the world. Asia's done okay. The emerging countries of China and India have done best. But the Western world, the European Union, the US, Britain, have all really struggled to get through this. And it's proving to be a very long, slow, hard slog. And the concern is that we're about to enter the second phase of it, that the recovery was a bit of an illusion, and we're about to see what's known as a double dip recession. So you have a recession, you come out of it for a while, and then you go back into it again. So that's what's really worrying markets. And obviously the breakup of the single currency would make that much more likely. If some countries defaulted on their debts or left the single currency, that would actually, I think, be the equivalent of what happened to global markets when Lehman Brothers went bust in 2008, perhaps even worse. It's not all bad news for the person on the street. There are some good things happening, two in particular. The first is that one effect of all this global mayhem is that oil prices are coming down very sharply. So there's been something like a 5% drop in oil prices this week. And that should feed through into lower petrol prices and into lower domestic energy prices. And given that one of the things which has been holding back the economy here and in the rest of the world for the last 6, 9, 12 months has been the fact that people, after they've paid their energy bills and their food bills, haven't really got an awful lot left over to spend on the good things in life. That should help that situation a bit. So people's real incomes should rise a bit and they should be in a position to spend a bit more money. That'll probably take a bit of time though for these things to work their way through. So that's the first piece of good news. The second piece of good news is that in the UK, an awful lot of money has been coming into UK government gilts. These are sort of government bonds which the government raises money from to finance our borrowing. And the interest rate it's got to pay has been coming down because money has been coming into London. So interest rates on government bonds are sort of their lowest level since 1946. And the level of government gilt yields, as they're known, affects things like overdraft payments, overdraft charges and long-term interest rates. So there's a chance that mortgage rates might come down as well. The bad news, of course, is that share prices have taken a real hammering. So people's pensions have been really, really heavily hit. If anybody was retiring any time in the next month or so, they'll have seen the value of their pension drastically hit. And there's the danger also that any good effects will be swamped by a new recession in the economy. So that if the European Union were to see a breakup of the single currency, or if the US economy really did struggle, then we would see recessionary conditions here almost certainly, and we'd have higher unemployment, and we'd see bad news coming through in that way. My fear is that we're halfway through a 10-year crisis here, that the crisis started in 2007. We're perhaps halfway through it at best. I think this is going to take a heck of a long time to work its way through. It wasn't a normal sort of recession. Normal recessions are one where inflation goes up because people, demand, they spend too much money, or they spend money they haven't got, and they push up inflation. And the central bank then comes in and clobbers the economy with higher interest rates, and that does the trick. And once the economy's cooled off, they cut interest rates and recovery starts again. This wasn't that sort of recession. It's one caused by people and banks getting into far too much debt. And people are now just gradually getting rid of their excess debt. They don't want to hold as much debt as they were before. They're tightening their belts. And so just the ordinary old-fashioned policy remedies don't seem to be working, such as cutting interest rates aggressively. I don't think it's being helped by the ham-fisted way in which the European Union is handling this crisis. I mean, one person in the markets talked about Jean-Claude Trichet in the European Central Bank being a pretty inefficient fire brigade, and that's absolutely true. If you think about it, what really needs to happen here is for the European Central Bank, which has got quite a lot of muscle, to come in and put out the fire that's raging in, not just now in the periphery of the European Union, but in some of the core countries like Italy and Spain. Unfortunately, Trichet seems like a fire chief who doesn't really want the job. He doesn't seem to be someone who's particularly interested in putting out the fires. To the extent that he is, he thinks the problem is with the people who started the fires rather than with him. He wants them to go on a course to get rid of their arson type tendencies before he'll actually go there and sort the fire out. He's got a fire engine which is really not big enough to tackle the job. It's probably got about a quarter of the water in it that it needs to hose things down. And when he was pressed on it yesterday, he said that he was actually out there helping countries by buying their bonds, but the countries he was helping were not Spain and Italy, but Ireland and Portugal. This is a bit like a fire chief who sends his fire crew to the wrong house to put out the wrong fire. So the European authorities are not covering themselves in glory here, and it does really smell very much like August, September 2008, when the American authorities badly mishandled the Lehman crisis and precipitated a 4-week period where no bank in the world looked to be safe, and that even after the central banks and finance ministries stopped that from happening, still led to the very, very deep recession in the winter of 2008-2009.